Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Palantir.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. For many investors, Palantir is, one of the most exciting yet maybe terrifying propositions in AI right now.
Right, there's a real tension there.
Exactly. Our mission today is to cut through that noise. We want to deliver what you need to understand the core conflict here, balancing an extreme valuation against potentially explosive AI-driven growth.
And the place to start has to be with the financial data, because no matter how you feel about the stock price, the numbers from Q3 2025 were genuinely staggering.
Staggering is the right word. We're seeing this incredible financial momentum, and it's being fueled by a completely new engine.
A powerful new engine, yeah.
That's the key to the whole thesis. I mean, the overall growth figures set the stage. Palantir reported Q3 2025 revenue of $1.18 billion.
Which is a huge 63% increase year over year.
A massive jump. But what makes this so different is where that money's coming from. Historically, it was all anchored by government deals.
And that's still strong, right? Over half the revenue.
Still 55%, yeah. But the commercial enterprise segment, that's where the story is.
Yeah.
It has finally started delivering the momentum everyone was waiting for.
That is the breakout detail. This is what's fundamentally shifting the narrative around the stock. We have to unpack the U.S. commercial segment. For that segment alone, revenue growth hit an unbelievable 121% year over year.
121%.
It totaled $397 million in just Q3. And their U.S. commercial client count jumped 65% year over year.
Think about what that surge implies. It just confirms that the momentum is no longer only about those massive long-tail government contracts.
Right. It's not just defense deals anymore.
No. They are succeeding in selling this highly sophisticated AI platform to a huge number of businesses, proving it scales.
And it's not just about how fast you sell. It's about efficiency, which is just paramount for software companies trying to scale.
Absolutely. And when you look at their efficiency metrics, the story gets even better.
You're talking about the operational leverage.
Exactly. The adjusted operating margin reached 51% in Q3.
51%.
Which brings us to, the rule of 40 for listeners who might not track these SaaS metrics daily.
It's pretty simple. It's just a company's revenue growth rate plus its profit margin.
Right. And if you hit 40% or more, you're considered a healthy software company.
So if they hit 40, they're healthy. What did Palantir hit?
Well, you combine that 51% operating margin with the 63% revenue growth. And the company achieved a Rule of 40 score of 114.
Wow.
To put that into perspective for you, a score over 70% puts a company in elite, world-class territory.
So 114 is just...
It's almost unheard of. It signals truly incredible operational scaling. They're growing extremely fast and managing expenses better than almost anyone.
And that kind of margin means they're generating serious cash. Profit margins hit 40% in Q3.
Robust free cash flow. Which leads to an interesting decision. They aren't doing buybacks or dividends.
No, they're pouring it all back into R&D and customer acquisition.
Which reinforces that management believes they are in a land grab phase right now. They're trying to conquer the market, confident the long-term returns will be worth it.
Okay, so the numbers are stunning. Unprecedented efficiency and commercial acceleration. But the next logical question is, how do they keep this going when you have giants like Google, Amazon, and Microsoft also innovating?
What's the moat? Yeah.
Exactly. What's the competitive moat here?
The moat is all about the platform itself and the switching costs it creates. Their core product, AIP, along with Gotham and Foundry, it's not just a collection of tools.
It's an operating system.
It's an operating system that gets deeply integrated into the core data workflows of a business.
But you hear AI platform thrown around everywhere now. How is AIP actually different from, say, just using an API from OpenAI or an Azure service?
That's a great question. The difference is in execution and complexity. General cloud providers sell you the building blocks, the raw models, the infrastructure.
The raw materials.
Right. Palantir sells a specialized, secure execution layer that automates incredibly complex tasks immediately. It lets a huge manufacturer pull data from dozens of disconnected legacy systems.
Inventory, shipping, all that mess.
All of it. And then use secure AI agents to optimize their entire global supply chain in real time.
So it's moving from just intelligence gathering to intelligence action.
Precisely. Once a client, especially a major defense contractor, has integrated their most sensitive data into AIP, Ripping that system out is catastrophically expensive.
That's the lock-in, the high switching cost.
That's the structural advantage, and that's what justifies the high margins.
Which gives us confidence in the forward outlook. Management is obviously confident, raising their full-year 2025 revenue guidance to a midpoint of $4.4 billion.
Which projects 53% year-over-year growth. And looking ahead, analysts are forecasting another, 41 to 54% for 2026.
And the consensus around that guidance is really strong.
It's extraordinary. We have seen 24 upward analyst revisions in just the past 3 months, and 0 downward ones.
0.
That level of unanimous conviction is a powerful market signal. It suggests even the analysts are struggling to keep up with the pace of their growth.
Okay, let's transition now to the technical setup and what catalysts investors should be watching for in 2026, because the stock had a massive 2025.
It really did. The stock doubled, up about 140% for the year, extending what is now a very clear multi-year uptrend.
We've seen some pullbacks recently, though.
Healthy pullbacks. You can chalk it up to profit-taking, some sector rotation, money moving from software to chips for a bit. But the overall picture is highly constructive.
And when you say constructive, what does that mean practically? For listeners, what does trading above the 50-day and 200-day moving averages really signal?
It just signals market health. Momentum. The 50-day is your short to medium-term trend. The 200-day is long-term. When the price stays above both, it means the average investor who bought in the last year is still profitable.
So less panic selling.
Right. It suggests ongoing institutional accumulation. People are buying into the long-term thesis.
So for investors looking at near-term events, what is the single most important thing on the calendar?
It's the Q4 2025 earnings report. That's a big one. Should drop late January or early February 2026.
And the market isn't just focused on them hitting their guidance.
Not at all. The consensus is heavily anticipating a continued beat and, more importantly, another guidance raise for 2026.
And what's the one number in that report everyone will be watching?
The continued acceleration of U.S. commercial revenue. If they can show that 121% growth wasn't a fluke, but that it actually sustained a triple-digit pace, that's the signal.
Right. That validates the whole rally.
And beyond the company's own results, you have the broader macro environment helping out.
You've got some tailwinds here.
Huge tailwinds. The expectation of Fed rate cuts in 2026 typically favors high-growth software. When rates fall, future earnings are discounted less.
And a big chunk of Palantir's valuation is based on profits years from now.
Exactly. Cheaper money makes those future profits worth significantly more today.
There's also some speculative chatter, right? Any rumors investors should be monitoring?
Yeah, the talk really focuses on partnerships, the idea of accelerated AIP adoption through specific commercial channel partners that could just rapidly increase their reach.
Okay.
And on the government side, people are watching programs like the Army's ShipOS initiative for long-term visibility.
So we've now painted a picture of near perfection. Explosive growth, insane efficiency, a sticky moat.
Right.
But we have to address the elephant in the room. This massive run-up has to bring significant risk. What is the core bear case?
The core bear case is valuation. Plain and simple. We have to be honest about the multiples here.
Okay, give us the numbers. Ground this risk for us.
Okay. Palantir is trading at around 119 times trailing price to sales.
119. For context, the average enterprise software company is happy with, what, 10 to 15 times sales?
If that. And even more critically, the stock is trading at over 251 times forward price to earnings.
251 times? I mean, most high-flying tech companies are thrilled to hit 50x forward earnings. We are talking about 5 times that level.
It implies that the market is already betting on sustained perfection for the next 5 years.
So any slip-up is a problem.
A huge problem. If growth slows even slightly, if it normalizes to a still great 30 or 35%, the justification for these extreme multiples just evaporates. It's priced for flawless execution.
And that extreme valuation highlights other risks too, right? What else worries the bears?
Well, they worry about customer concentration and competitive convergence. Even with the U.S. commercial boom, they still rely on a few massive government contracts.
So if one of those pulls back, it's a major hit to revenue.
A significant destabilization. And on the competitive front, you have the hyperscalers. Amazon, Google. They're investing trillions in AI. The bear case is that one of them eventually catches up and just undercuts Palantir on price.
And you see this division of sentiment in the market. You have big institutions accumulating shares.
Buying in.
But then you also saw that very notable disclosure from Michael Burry, who disclosed significant put options on the stock.
And that split tells you everything. A put option is a formal bet that a stock's price will fall. When someone like Burry, who specializes in identifying deep overvaluation, takes that position,
It's a huge signal to the market.
it signals that at least one very serious, high-profile investor thinks the price is totally detached from fundamentals.
So how do we synthesize this risk? We see that most analysts, 11 out of 16, are currently sitting at a hold rating.
Right, and that hold rating is the market's way of saying the company's performing flawlessly, the tech is revolutionary, but we can't recommend the stock because it's already priced for that revolution.
The good news is already baked in.
It's priced in. The investors buying now are betting that the AIP moat is so strong that it fundamentally changes the market size, justifying that premium.
Which brings us to our final thought. We've covered everything from the 121% U.S. commercial surge to the staggering 251 times forward PE.
It really is a story of growth versus price. It captures the tension of the AI market perfectly.
The core question for any investor isn't if the technology is working, the numbers confirm that it is, but whether the pace of U.S. commercial growth can accelerate enough to make 251 times forward earnings look like a historical footnote by 2027.
Yeah.
That sustained acceleration is the key variable that either unlocks huge upside or risks a dramatic correction.
A provocative thought indeed. If you enjoyed this analysis into the financial and strategic drivers of Palantir, please remember to subscribe and join our community for more analyses like this one.